What's going on, guys? It's Vic, and today we're talking about the bear market that is basically already in right now. We know that the Russell is in bear market, the NASDAQ is in bear market, and both of those indexes have been in bear market for quite some time right now. But the market that really matters, the index that really matters, that is basically the market when people say the market, is the S&P 500, which went into bear market for a little bit but has now come above, just teetering on that line of down almost 20%, that being official bear market being down 20%. So that big index that everyone is kind of waiting to see what happens with it. Does it go into bear market or does it recover from here? And this is the bottom. Who knows? Either one is very possible, and it's very easy to see us falling even further down. If it does go into official bear market, things could probably get way, way worse, at least for the S&P, because the NASDAQ and Russell, those are down like 30% plus, with the S&P not even down 20%. So we'll see if it catches up to them, or if the NASDAQ and Russell start to recover and get closer to what the S&P is kind of trading at. Usually they're not that far off trading. But for the market, we had some pretty bad signs with Walmart and Target reporting earnings that were just not very good at all. And it kind of spooked the rest of the market for at least the retailer side, because obviously two retail giants, Walmart and Target, not doing good, not having great earnings, and not having great guidance going forward. It's not a good thing for the market to go through. And we can see that right here with this talking about Walmart. This right here, Walmart stock falls sharply after earnings miss and forecast cut. So both of those things combined, you don't want either of them, but especially in this environment, you definitely don't want both of them together, which is what Walmart did. So this is their kind of guidance here, talking about earnings per share, however, could decrease about 1% or be flat compared with last year. Not what you want to hear, especially when what was guidance issued in February was expecting earnings per share to rise by mid to single digits, or about 5 to 6%. So they went from we should go up 5 to 6% in earnings per share to we want to stay flat. We don't want to go down. We want to be flat or plus 1%. Not what you want to hear. That's no growth. That's nothing really going forward. It's a massive problem. And what this could mean is people, because obviously people shop at Walmart, they are struggling with their money right now. They're not going out and spending money. They're basically buying essentials and not buying either luxury things or anything extra. They're buying food to eat, and that's basically it. And we see that right here saying, nonetheless, management said that higher grocery prices still cause shoppers to pull back from other categories as they prioritized food. Obviously, you have to eat. That's what people are going to prioritize. The price of food's going up. Inflation is going absolutely crazy. The price of food goes up. People are going to spend money on food because you have to eat, and not spend money on something else that they don't necessarily need. So, gas prices going up at the rate they are, food prices going up. You combine those two, people aren't really having discretionary income to kind of just throw around like they had the past couple of years even. Here, Walmart is a bellwether, not only because of its size, but because it tends to serve a lower income demographic. They are of particular concern given that they are hardest hit by spiraling costs of essentials, and are also likely to feel the loss of government stimulus most acutely. I don't know if, I guess Walmart, you can see lower income demographic. I would say everybody shops at Walmart. I don't think it's specific to poor people, but you can see anyone shopping at Walmart, and Walmart's a good kind of a look at how things are really going. If people are going to Walmart and just buying essentials and leaving, you might have a problem. We might have pretty tight money out there, and people don't have discretionary income and extra income to throw around. If people are going to Walmart and they're just buying all sorts of things, they're having a good time, then we're probably in a better spot where people have more money and more discretionary money to use on whatever they want. And if we want to look at the Target side of their earnings that were obviously very bad coming off of Walmart, we can see them saying the strength of the consumer will be tested as both Walmart and Target signal rising pricing pressures are not easing. So that means the end of inflation probably not here. The Fed rate hikes probably going to continue to need to happen, and people just inflation's not going away anytime soon. according to this, pricing pressures are not easing. That's not a good thing. That means inflation probably still going to be going up or still going to be here. You see Target shares on Wednesday dropped 25%, the most since 1987. Ridiculous, the insane movements we're seeing all over the place right now. Historic moves, which is just insane volatility, and living through historic events left and right. Apparently, once in a generation events happening every single year, it seems like. But again, we have the CEO of Target talking about saying growth was challenged by unusually high costs, resulting in profitability well below what we expected to be and where we expect to operate over time. And they had adjusted earnings fell 40% compared to the year ago period of $2.10 per share. That is massive. Adjusted earnings fell 40%. Insane movement, just shows the weakness in the consumer, really. And if we're looking at charts of Walmart and Target, we can start with Walmart. I mean, can you guess where their earnings came out and where it really just started to go south? Basically fell off of a cliff here from 149 almost 150, and just gapped down all the way to open at 136 and continue going down, another gap down, and just 4 red days following their earnings report. And if we zoom out on this, we can see just how devastating of a move down this was. This is a weekly candle. I mean, ridiculous. It's basically, if we go back here, we can see 2020. So this is around early 2020 with the volatility and stuff. If we go, we're almost down at these levels. Like let's call it 112 for an average, would be around where Walmart would be pre-COVID pandemic blow up in price. They didn't have a massive move down in price like other things did, but this is still approaching those levels, which is insane to think about that. And if we go on to Target, we see the same story. It's literally the same thing, just a massive gap from they were at 216 a share all the way down to they got opened at 163, got down to 155. That's where they're currently at. Ridiculous moves for Target. Insane retailers moving like this. Historic moves for Target and Walmart, and just ridiculous volatility. All of that coming from inflationary pressures, the Fed pressures, stock market in a bear market. So if you don't have great news, it is bad news, and that'll send your stock down. And we're seeing that time and time again with Apple earnings, with the big tech earnings. Apple had great earnings. It fell down hard after its earnings because of guidance and stuff. Walmart, same thing. The earnings weren't terrible, but the guidance wasn't good. And any bad news is really bad news in this market. And the next retailers we have to look for earnings is Dollar General and Dollar Tree, and I think Best Buy all next week. And they're already reacting negatively to Walmart and Target earnings. So Dollar General fell 11%, which was its biggest decrease since 2016. Dollar Tree tumbled 14%, its largest percentage decrease since 2001. So again, insane moves happening on these stocks that don't normally happen. This volatility is ridiculous. Things are swinging up and down and going mostly down at this point. So, and then this again, although Dollar General and Dollar Tree don't report till next Thursday, the market is worried they won't have good things to say after Walmart and Target report earnings. Those fears are justified. Hopefully they don't have bad news, because their stocks are already going down in anticipation of bad news. If they report actual bad news, the stocks are probably going to get obliterated. And for some of the biggest metrics to look at right now, from the Fed at least, some data from the Fed, are things like personal savings rate, which we can see kind of the mean around here, around 6 to 7, call it. If we zoom in on this 2020 stuff, obviously we know stimulus peaks, so all these are peaks of stimulus, and then that didn't last long, and going all the way back down to around 6.2. If you zoomed it out still, you could say, we went back down to the mean, which is all right. But you combine personal savings going down and at lower levels than they were just a year prior or even 2 years prior. That obviously stimulus helped pump those numbers up. but they fell back down. And at a time with insane inflation, cost of goods, and essentials skyrocketing, not a good combination, as well as not a good combination to have household debt service payments as a percent of disposable personal income. This stuff, so this is paying credit card debt, credit card bills, these like debt bills as your disposable income, this is going up. So we can see this was on a pretty big move down. So historically, it's really moving down, but this has been around 9%, just under 10%, really. If we go and zoom this back in, we can see this was again kind of stimulus things, again paying off debt and getting debt lower, and we see it already spiked back up to 9.3. This is still not good, showing people getting into more debt to pay for things, probably. So combine people getting into more debt for pay for things, meaning their debt service payments are growing as their disposable income, as a portion of their disposable income, personal savings rate dropping, not a great combination. And on top of this, if you're paying debt instead of buying goods or traveling or anything, that's going to negatively affect the economy, and that's going to be very bad. Obviously, we already have these huge recession that we're pretty much in, and even if recession fears here, and if more of your money has to go towards paying off debt, it doesn't go towards the economy, towards spending money, buying things, or traveling, and that just adds way more recession kind of fears into the market. So ultimately, a lot of things adding up, not looking great for the economy, with the giant retailers having bad earnings and bad guidance, saying, we don't even think the worst is necessarily over. Walmart and Target saying that. And even we see Dollar General and the other kind of retailers, if they have bad numbers, I mean, they're just going to get obliterated, and the stock market's going to continue to move down. The bear market is here, and there's a lot of factors adding up as to why it could still even get worse from here. But we'll see what happens. Hopefully, these other companies don't have so super bad earnings and things can start turning around, but it's looking pretty grim for that happening. But that's gonna do it for this video, guys. As always, don't forget to smash the like button and subscribe. We're on the road to 1,000 subscribers. I'll see you guys in my next video.